What we can start with is a little bit about, private equity procurement. I mean, how does procurement figure into the private equity equation? Why does private equity seem to care so much about procurement and supply chain? How do those businesses operate?
When I first got into private equity about, over 10 years ago now, which makes me feel even older than I really am, private equity wasn't thinking very strategically about procurement. They were nibbling around the edges, and they were thinking about it in terms of cross portfolio. Let's go sign a
Okay.
contract with FedEx and have all of our companies use FedEx and we can save money. Let's go sign a contract with Dell or with Lenovo and they'll all buy the same computers and we'll save money that way. And when I got to my first PE firm as an operating partner, I started going through the spin. I'm like, you realize that we're like a Fortune 75 company if you take all the direct material spend that we use, and the money's going to be there. It's not by nibbling around the edges. So we really transformed how private equity started to think about procurement by going after direct materials and adding to EBITDA that way. Now, the reason it became so popular is that you can very, very quickly add EBITDA to the bottom line in a private equity situation. And it's dollar for dollar. You don't have to go sell with a 20% margin and sell 5 units to get $1 worth of margin, right? You can go and every dollar you save goes right to the bottom line for the most part. So you can do it very, very quickly. It's a one-for-one impact, and it doesn't necessarily impact people. So you don't have to necessarily get people to think differently about how to go to market. You don't have to go to your customers and raise prices. You don't have to go through a product development phase and introduce a new product. So it's quick, it's actionable, and most importantly for private equity, it's tangible and quantifiable.